There are two pages where you're going to enter liabilities. There's the current liabilities page and the term liabilities page. So we'll deal with the current liabilities page first. Again, the definition of current liabilities is debt that is scheduled or would normally be repaid within 12 months. So there are three sections to the current liabilities page. There's the top section, which includes operating loans and short-term accounts. Then there's the accounts payable section at the bottom, and there's the new current liabilities section. Looking at the top section, the first place where you can make an entry is on the deposit interest rate. And this is where you would show what would be paid on a balance in the checking account. Remember when we talked about the cash pot, the cash is dealt with as being either positive or negative. If it's positive cash, it would indicate that there should be cash in the checking account. If it's negative, then that would indicate an operating loan. If there's going to be cash in the checking account, the lending institution may pay interest on that amount, and that's what you would enter here. And again, you can click on the little triangle to get the comment box. Below that, then, you can make entries for operating loan and feeder line. Just look at cells C3 and 4. You'll see we have credit limit, a double line, and then date, last interest. And what that means is that in this column, for the two cells above the double line, so that's for the operating loan and the feeder loan, what you'll put in those cells is the credit limit. And again, you can look at the comment box. In this column below that double line, what you'll enter is the date of the last interest. And again, there's a comment on that. So looking at the operating loan and feeder line, as you go across, then you'll enter the amounts outstanding. Because we're not entering a date to start, as in column C, we're not entering a date, for these two items, if there is going to be an interest amount calculated above the amount outstanding, you would enter the days out and the interest rate, and then the program will calculate the accrued interest on those amounts. So that would be the accrued interest to our statement date. As we go across to the right then for operating loan, you'll see those cells are all blue. And as discussed earlier, the program calculates any changes in the amount of the operating loan as cash flows in and out. So we're not showing projected payments on operating loan. But for the feeder line, you'll see that you can make entries in the first payment amount, and the first payment date and second and so on. So for the feeder line, you can actually show expected payment dates and amounts for the projected year. Going down, you can enter feeder loans. There are two rows for showing feeder loans. And in the feeder loans and going down in column C, again, you would put in the date of the last interest. The reason you do this is the automated features that the ABA program has. If you define the loan completely, give the program all the detail about any of the debt, it will do the calculations. So it'll do the calculations for cash flow, and you'll see when we get into the term liabilities page, it'll do your cash flow and payment calculations and those things. But it requires that we provide certain information. And in this case, and for all the loans, other than those two that I mentioned above, we need to put in a date so the program knows how to calculate the interest. So for the other entries, the feeder association, the feeder loan, and then my two examples, the input loan and the credit card, as you move across, you just make those entries, the amount. Because we put in a date of last interest payment, the program is able to calculate the number of days out. You need to enter the interest rate, and then of course the amounts of expected payment and the dates for those payments. For the payment amounts, you'll put in the principal amount that will be repaid. The program will calculate the amount of interest additionally to that. When we get to the cash flow page, in particular the cash flow page that deals with operating advances, you'll see that the payment amount will be what is shown as principal plus the calculated interest. So in this case, for the input loan, in addition to the $50,000, there will be interest from the date of the last interest, which is December 16th, to the date of the payment, which is January 15th. So what will actually come out in terms of cash flow will be $50,000 plus that interest. So when you're showing or entering the amounts of payments, just remember that the amounts of the payments would be equal to the amount that is outstanding. Now, you actually can leave some of this debt outstanding through the year end. So if you don't show the full amount being repaid, as we are in this example, any amount that isn't repaid will carry through to the ending statement and be carried out at the end of the year. Going down then, we've got the operating or the accounts payable, and those are dealt with the same way as with the feeder association, the input loan, the credit card loan examples above. The bottom, there's a section for new current liabilities. So this is current debt that is expected to be borrowed in the projected period. And we have a couple examples. There's a feeder association loan and an input loan. The expectation is that the feeder association loan would be borrowed in June. You can see in the advance date column. The input loan would be borrowed in May. For all the debt, pay really close attention to the requirements of the last payment date. So if we go up and look at the accounts payable section, if we put our cursor on the little triangle, you'll see that what you enter is the last date in the previous year that the amount outstanding was interest-free. So that's the date you would put. In the Frank's Fuels example, the last payment would have been October 1st, 2014, and so as of our statement date, which is January 1st, 2015, there would be 92 days of interest at 12%. So on January 1st, 2015, in addition to the $6,873 outstanding, there would be additionally $208 of accrued interest. In the new current liabilities section, the date is just a little bit different. So if you put your cursor on the red triangle again, you'll see that the date that you put here is the date the last interest payment on the new loan will be made for the upcoming year. So it's a little bit different. So let's just look at the feeder association loan. You'll see if you look at the advance date, that loan is going to be taken out June 1st, 2015. And if we look at repay date, it's going to be repaid on November 1st. So the date that we have for the last payment date is November 1st, 2015. And if we look at the FinCo input loan, it's going to be taken out May 1st, 2015. Going across to principal repaid, $100,000 is going to be repaid, but $200,000 is going to be borrowed. So the scenario here is that $200,000 is going to be borrowed in May, $100,000 will be repaid in December, and $100,000 will be carried out at the end of the year. So what we put in for the last payment date in this case is December 31st, 2015. And again, if we look at the little comment box, that's the date the last interest payment on the new loan will be made in the upcoming year. The key to this section, the new current liability section, really is, again, number one, to describe these loans completely. It's the program uses your description to do the calculation and to make sure that all of the information required is entered. And that includes things such as advance date, repayment date, and principal repaid. The second liabilities page is the term liabilities page. You'll see there are 3 sections: intermediate term liabilities at the top, then long-term liabilities, and then again a section where new term liabilities or projected new loans can be added at the bottom. Again, looking at our definitions, intermediate debt is debt that is scheduled to be repaid between 12 months and 10 years. So examples of intermediate term debt are typically things like loans for vehicles, loans for equipment, very often loans for breeding livestock, those kinds of things. And for long-term liabilities, for long-term debt, it's debt that is scheduled to be repaid beyond 10 years. And very typically, those include things as loans for land and loans for buildings. But it's not the use that defines the debt, it's the number of years in the repayment of that debt. So in terms of programming, this is a really big page. The majority of the programming for the ABA program happens with this page. The main automated features of the program happen here. And as we work through the program, you'll appreciate that. I'll just point out some gray buttons at the top, and there beside each of the names, the intermediate term liabilities, the long-term liabilities, and also the new term liabilities. And we call those macro buttons. There's one that's called interest, one that's called principal, and then years and payment. And actually, if we go off to the right-hand side, there's another one for both the intermediate and long-term, and it's called retire loan. So these are macro buttons, and the way they work is that if you've got certain pieces of information, if you click on the cell that you want the calculation to be done in, and then click on that macro button, the program will do the calculations. So again, what we need to do in this section is make sure that the liabilities are fully defined. And then the programming that runs in the ABA program will do the work. So again, as you enter the loans, you need to move across from left to right and be sure that the information required is all entered. So just using the first one in the intermediate term liability as an example, here we've got B of A loan for a John Deere 9230. You need to enter the last payment date. And again, as I mentioned on the current liabilities, the same thing applies on this page. Make sure that the date is right, and it does change depending on the page you're working on. In this case, if you click on the little red triangle, you'll see that what you need to enter here is the date the last loan payment was due in the last year, not necessarily paid. So in this case, we know they are semi-annual payments, because if we go across to the right, the payments per year is 2. So the payments would be November 1st and May 1st. But our statement date is January 1st of 2015. So with that payment schedule, the last payment date for this loan would be November 1st, 2014. It's a blended payment, so you'd put a B. And what that means is it's amortized. The option is to put an F in there for fixed. And what that means is that the payments would be fixed amounts of principal plus interest. Put in the interest rate, the number of times per year the loan is compounded. In the principal outstanding column, you'll put the principal outstanding at the start of the year, not in arrears. And it's the not in arrears part that is really important. So we might have a situation where an account is in arrears. as we can see in the B of A mortgage in the long-term liabilities. But the amount that will go in this column is the amount that would be owing if the loan wasn't in arrears, because the arrears are dealt with in columns off to the right. So then as we move across to the right, number of years left. If you've got any question, you can look at the comment boxes. And the payments per year, so here you'll be saying if it's an annual payment, semi-annual, quarter, or monthly. And those are the options. Weekly payments are not programmed in. If you have a loan that's got something like weekly or bi-weekly payments or some odd repayment schedule, you need to make it fit the requirements of either annual, semi-annual, quarterly, or monthly. And monthly payments would be shown as a 12, so you would have 12 payments per year. The payment amount then is the amount of the payment, obviously, but what you'll put in here is the constant amount. So if it's an amortized payment, you'll put in the full amount of the payment. If it's a fixed payment, you'll put in the amount of the principal. So in an amortized payment, the total payment doesn't change, so that's what you'll put in. If it's a fixed payment, it's the principal amount that doesn't change, so that's what you'll put in. And the amount that you'll put in will be the amount of the payment in that particular payment, not the total amount of payments for the year. So for example, in the B of A loan for the John Deere 9230, there would be two payments of $13,759.12. So it's the individual payment amount that you enter. Just going across then, if it's expected that there would be an unscheduled payment amount, perhaps some unanticipated money is going to come in, or there's a lump sum going to be paid, you would put that amount in here. If the loan is in arrears on the statement date, again, you'll put in the amount that's owing for interest and the amount that's owing in principal. And going across, if the loan is going to be retired, this is the retirement amount. And if it's going to be, if arrears are going to be paid or the loan is going to be retired, there would be the date. In column W, the date would go in there. And I'll just provide a little further explanation as to how that works and how the macro works in that section in a minute. And then going across to the right in the very last column, if an unscheduled payment is going to be made in column M, then the program needs to know the date that that will happen. So just dealing with the macro buttons. Again, there are 4 macro buttons in the first part of the payment information. And what that allows for is for the program to calculate one of those items if you have the rest of the information. So for example, in the B of A loan for the JD 9230, if you had all the information on that loan but didn't know what the payment amount was, you could click on that cell, and at that point it would be blank. Click on that cell and then go up and click on the gray payment macro button. And the program will then calculate that payment. Alternatively, if you had all the information but didn't know the principal outstanding, so if the principal outstanding cell was blank, you could click on that cell and then go up and click on the gray principal macro button above it, and it would calculate the principal amount outstanding. So going across then to the retire loan area, if this loan is in arrears, and I'll move down to the B of A mortgage loan as an example. This B of A mortgage loan is in arrears, $29,092 of interest and $21,520 of principal. And we've shown that it is the intention to make that payment on February 1st, 2015. So when we put that information in, what the program does is build payment of those arrears into cash flow. And when we go over to the operating loan advances cash flow page, you'll see where that payment amount comes in. Now, if the plan is to retire that loan or any of these loans, any of the term loans, if you have an amount in column W, which is the retire loan and or arrears date, if you have a date in there and then click on the cell in column V, which is the retire loan column, and click on the retire loan button, the program will calculate how much it will take to retire that loan as of that date. So in this case, February 1st, 15th. And in addition, because you've provided all the information, all the detail on the loan, the program will be able to do all of the cash flow calculations and again show the year end or the period end amounts on the loans. So all those things are calculated automatically. Just a point to note about the function of these things. Occasionally inconsistent information is entered. And let's just go back to the B of A loan for the John Deere 9230. All of this information could be entered as we show, but maybe the payment amount is wrong. Maybe it's entered as $15,000 instead of $13,759. You would have inconsistent information in that it would be some of the information would be contradictory, because if you paid a different amount, the number of years left would be different. So it's important for the program to function properly, and considering that so many of the functions are automated in the program, to make sure that all of that information is consistent. So what I suggest for any one of the loans is, if there's any piece of this information that you're not entirely certain about, you leave that cell blank. So for example, for this first loan for the B of A JD 9230, if it's uncertain what the principal balance is, but we know there's 4 years left, it's semi-annual payments, we know the payment amounts, etc., that you leave the principal amount outstanding, that cell blank, and use the macro to calculate the principal amount. Or if you're certain about everything else, leave the number of years cell blank and use the macro to calculate the number of years. And what the program will do then is it'll remove any of those inconsistencies in the information that is generated will all be accurate and as per your expectations. So the long-term liabilities section functions the same as the intermediate term liabilities section. There really isn't anything new to add about that. But moving down to the new term liabilities section at the bottom, again, the last payment date, it is just a little bit different. So unless you really know what is expected there for last payment date, look at the comment box and you'll see that this is the last date that interest will be paid in the upcoming year. So in this case, it's planned to purchase and finance a new haybine and baler. A new loan is going to be taken out. If we go across to the right, plans are to borrow the money on June 1st, 2015. The first payment date is going to be December 1st, 2015, and that will be of both principal and interest, as you can see, same date in both those columns. So the last payment date in the projected year, in this case, is going to be December 1st, 2015, because again, our projected year, as we defined it on the title page, is January 1st, 2015 to December 31st. It's going to be a blended payment, 6% interest, semi-annual payments. $50,000 is going to be borrowed, 5-year amortization. It's going to be semi-annual payments, so we've got a 2 in that column. And then here you would want to use the macro to calculate the payments. So click on the payment amount cell for that loan, and then click on the payment button, and the program will calculate the payments. And again, automatically do the allocations of funds for cash flow and debt service and all those things going forward. Now, the top part of this page that we were just looking at and talking about is called the input section. And it's a big page, and there's a lot of information on there. So in the program, we created a print section. And if you scroll down, you'll see at the bottom of this page, starting in row 55, there's a section that's called Loan Information Print Section. When you print this page, then this is the page that you'll see. This is the page that will print. Now, another advantage of having this print page is that it gives you total owing amounts. You'll notice on the input page and the input sections above, we've got all the details on these loans, but nowhere on this page does it say how much is actually owing on the statement date or how much would be owing at the end of the year. If you look at the print section at the bottom, that information is there. So the information on the debt is summarized, and then on the far right-hand column, we have our total owing. In this case, it's January 1st, 2015, so that's on the statement date. So the information that you've entered all adds up to those total owing amounts. And then because of the automated features again, and the fact that the ABA program is able to do these calculations, it shows you here the amounts that would be owing on each one of those debts at the end of the projected period, in this case, December 31st, 2015. And the same thing for the new term loans at the bottom. We've now gone through the asset and debt pages and entered information about assets that are owned and debts that are in place. So we looked at the land, buildings, quota, machinery, both what they have on the statement date and what is projected for the upcoming year. Also for the liabilities, we looked at current liabilities and term liabilities that were there on the statement date, and again we looked at the projections for the upcoming year. All that information comes together on the net worth statement. So on this page we have assets on the left, we have debts on the right. In the green column, the first of the 3 columns in this example, January 1st, 2015, we've got the numbers from the asset statements. And in column H, the green column, January 1st, 2015 for the liabilities as we entered them on the 2 liabilities pages. You'll again see that assets and debts are both broken up into current, intermediate, and long term. And for each one of those sections, the amounts are totaled. Looking at the assets, as we go down, you can see at the bottom we have total assets, so that's the sum of all current, intermediate, and long-term assets. And in the liabilities section, as you go down, you'll see there's an amount for total debt. And below that total debt amount in column H is the net worth or equity, which is the difference between the total assets and the total debt. You'll see also there are 2 columns to the right on both the assets and debt, and those cells in those columns are white, which means that you can enter additional information about assets and debts at historic year ends for 2 additional years. The information that we entered was as of the statement date, in this case January 1st, 2015. So the previous year end would be December 31st, 2013, and the one before that, December 31st, 2012. If you have the information regarding assets and debts for those year ends and want to enter it, you can enter it here. It's not required, though, for the function of the program. But what it will do is give information so the program can do some calculations about performance and assets and debts for previous time periods. Towards the bottom of the page, we've got a section for some risks or for some ratio calculations. So you'll see the program looks at current ratio, debt to equity ratio, equity to asset ratio, and solvency ratio. Also, working capital. If you're wondering what the definition is for any of those ratios or indicators, go to the risk ratios page. It's one of the pages towards the end of this document, and ratios information and definition is provided there. If you've entered asset and debt information for the previous year ends, so that would be information in those white cells, then the program is able to calculate those ratios for those previous statement dates as well. If you haven't, then you won't have the ratio information in column D and E, which is calculated from that information. On the right-hand side of the ratio section, you will see there's a little area that is ratios adjusted for feeder cattle debt. So for feeder operations, there can be a lot of short-term debt to finance feeder cattle, and that can really skew the ratios and suggest a financial situation that is less strong than maybe it is in reality. So we have a little illustration here that shows how the adjusting for feeder cattle debt can impact the calculation of these ratios. So as mentioned, adjusting for feeder cattle debt, what the ABA program does is it recalculates the ratios, taking the amount of feeder cattle debt out of both assets and debts, and then reruns the ratios. So just looking at an example. In this example, there are assets, real estate, 200,000, machinery, 100,000, supplies, 100,000. There are 1,000 feeders valued at 900,000 with total assets of 1.3 million. There is debt, feeder cattle, 800,000, accounts 100, total debt 900,000, net worth of 400,000. So when we run the ratios conventionally, this is what is calculated. So ratios not adjusted for feeder cattle debt. The current ratio is 1.11. The net ratio is 0.31, which would suggest a weak situation financially, stressed situation. If we rerun those ratios, adjusting for feeder cattle debt, those ratios improve significantly. The current ratio goes up to 2. The net worth ratio goes up to 0.8, which suggests a much stronger situation financially. And in many cases for feeder operations, this might provide a more realistic representation of the financial situation and the financial strength of the operation.